And thank you for standing by. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question and answer session. To ask a question, please press star, then 1. You will be prompted to record your first and last name. Your host for today's conference is Patrick Shepard. Thank you. You may begin.
Excellent. Thanks very much. Good afternoon and welcome to the Ethics Fundamentals series. My name is Patrick Shepard. We're very pleased to join you today where we're going to discuss applying commonly used exemptions at 5 CFR Part 2640. And we are very, very fortunate to be joined today by Cheryl Kim-Piasecki, who is going to help us with that discussion.
Yes, I certainly am.
Sure. So I think we have a lot to cover here.
We do have a lot to cover.
So we're just going to go ahead and get into the deck and get started. We will have a question and answer at the end. If we have time, we can cover a few administrative announcements as well.
Okay, very good. In the materials that you were sent, you should have been sent the deck, which obviously we're going to pull up here in a second. We should have showing right now. And we also gave you a separate handout that had the exercises that we're going to be walking through today on it. So if you want to have that sort of a separate and apart so that you could take notes based on the conversation that Patrick and I are going to have about each of those scenarios in just a bit. In addition, we gave you some handouts, and we'll be making reference to those other resource documents, legal advisories, et cetera, as we go through the broadcast. We're going to start with a very brief overview of 18 U.S.C. Section 208. Our presumption was that everybody has this kind of in their under their belts, but just a really quick and dirty kind of review of 208 so that we can get into the 2640 exemptions, because as you all are aware, the exemptions are exemptions to this criminal statute. And if you are not enough familiar with the statute, then the exemptions are obviously not very meaningful to you. So just really quick, 18 U.S.C. Section 208 is a prohibition on an employee's participation in a particular government matter if the outcome of that matter would have a direct and predictable effect on the employee's financial interests, including the financial interests of certain others, including their spouse or minor children. But those interests are attributed to the federal employee. So the overarching purpose of 208 is to prevent an employee's personal interests from influencing their government decisions. And we do that by not allowing them to participate. So it's a participatory bar.
Right. And the exemptions we're going to discuss are exemptions to this law.
Yes.
Even though we find them in a regulation, it's important for us to remember that they're exemptions to a criminal statute. So we want to be careful.
Yes. And the authority for us to issue those exemptions is in that statute itself.
Right.
Okay. There is a common misconception that there's a government-wide restriction on holding certain assets, and that is not true. 208 is not a restriction on holding anything. 208 reaches to your participation in the matter, not to any particular interest that you might hold that could be affected by a government matter. So in the next slide, we just want to show that a 208 analysis, conflicts of interest analysis, is effectively, you're looking at a nexus. You always want to see whether or not there is a nexus between a particular government matter that an employee has been assigned to and any financial holding or other interests that they have that could be affected by the outcome of that matter. If you don't have a nexus between a government matter and the financial holding or other interest, you simply don't have a 208 conflict of interest.
And this is a process that should be familiar to anyone who reviews financial disclosure reports. But I think it's important for us to remember also that this law applies equally to all employees of the federal government, not just our financial disclosure filer. So we can see this in other places as well.
Exactly. So in the next slide, we basically, when we're talking about remediation, remedying a potential conflict or an actual conflict, which is what the 2640 exemptions are one of the remedies for a 208 conflict. There are basically two ways that you can remedy a conflict, because you have two pieces that have to be there in order for a conflict to exist. So you can either remediate the conflict by removing the employee from the matter, or by removing the disqualifying financial interest in the matter. And so we've just given you a couple of visuals of this. So in the next slide, we're basically just showing you that what a recusal does is a recusal is handling the particular matter half of that nexus. A recusal removes the person, so removes that matter from the nexus with the individual's personal financial holding or other interests. So once you've eliminated the nexus by not having the person participating in the matter, that is the primary way and kind of the default way to remediate a conflict, but that's just one of several ways that you can remediate a conflict.
So this, in sort of simple terms, if I'm asked to participate in a matter that has the potential to affect my financial holdings. The thing that I should do is not participate.
Precisely.
Just stop.
Yes.
Okay.
And that's really the key to tell employees, that if they believe at any point in time they have a financial interest in a matter to which they've been assigned, their first course of action should be not to participate, unless or until some other remediation can be arrived at. And the other remediation is what the next slide is going to be dealing with. So the other way that you can remediate a conflict is by somehow handling or getting rid of or taking care of the financial interest in the matter. And we can do that through a variety of ways, and it really depends upon what the nature of that thing is that gives the person the financial interest in the matter. If it's something that is subject to divestiture is one way that you can do it. We have written waivers that are available under 208B1. We're not going to be dealing with those today, but then we also have the 2640 exemptions, which are found, the authority for which is found in 208B2. 2640 is a reference to the 5 CFR Part 2640 regulations where those exemptions are housed.
So after I've identified that I have a potential conflict of interest, or I've been asked to work on something that might affect my financial holdings, the first thing I want to do is not work on that.
Yes.
And then I might look to another possibility, say it's important for me to work on that.
Mm-hmm.
I may qualify for one of the exemptions we're going to discuss today. I may be issued a waiver by an appropriate authority at my agency, or I may sell that conflicting holding. These are all sort of some of the possibilities.
Exactly. So again, just another visual representation of what we just talked about is the second way to remediate the conflict is to take away the financial interest part of that nexus in the matter. So that would allow the employee to continue to participate in the matter because they would no longer have a financial interest in the outcome of that matter.
Okay.
So we just want a few words about the 2640 exemptions that we're going to be focusing on today, just kind of as general proposition. Only OGE is authorized to issue exemptions. So, and that doesn't mean that we haven't and can't issue exemptions that are tailored to specific needs of specific agencies. It's just that agencies themselves do not have the authority to issue exemptions to the criminal statute 18 U.S.C. Section 208. These regulations, these exemptions are housed, as I said before, in 5 CFR Part 2640. They apply automatically, and by that we mean unless you have a separate statutory authority that gives you the ability to prohibit, for example, certain types of financial holdings, or unless you have issued a supplemental regulation that is going to, for example, prohibit your employees from holding certain financial holdings. The exemptions in 2640 apply automatically. They're not discretionary.
Okay.
And then finally, what the 2640 exemptions do is they not only mitigate or eliminate the 208 conflict of interest, but they also take care of any residual appearance concerns under the impartiality provisions.
Yeah, and I think, when we're looking at this, the big thing to take away is to remember that 2640 is about implementing the criminal law, 18 U.S.C. Section 208.
Right.
The exemptions apply only to 18 U.S.C. Section 208.
Right.
So if you're dealing with a problem under some other authority, 2640 isn't going to help you because it's only for 18 U.S.C. Section 208. And if you kind of remember that, you'll avoid some difficulties.
Yes. So our agenda for today is we're gonna be introducing a process for determining if certain of the 2640 exemptions apply, and we're going to be talking about the most commonly used or the most commonly encountered 2640 exemptions, which are those for mutual funds and unit investment trusts, publicly traded securities, and employee benefit plans. We're going to apply that process to some specific examples. We've given you those exercises in advance. And then we're also in the process going to be trying to show you some resources that you can use to assist you in engaging in that analysis. And the next slide with the analysis process is effectively, you have to first determine, before you even get to the 2640 exemptions, you have to first determine that 208 even applies. So your first question has to be, will the outcome of the government matter to which the employee has been assigned have an effect on an identified interest that the employee holds?
Right. So if we don't have a problem under 208, we don't need an exemption to 208.
Exactly. Once we've determined that there is a potential conflict of interest or an actual conflict of interest under 18 U.S.C. Section 208, then we have to ask ourselves, well, okay, is there potentially an exemption under 2640 that would basically take care of this type of interest that the employee has in this particular type of matter.
Okay.
We want to make sure that the exemption that we're going to rely on actually covers the type of financial holding or the type of thing that the person has. As we said, there are a variety of different instruments and different types of financial interests that someone can have in a matter that are covered by different exemptions. So we want to make sure if we look at an exemption that we're making sure that that exemption actually covers the type of financial interest the person has.
So where we see that there's a nexus between a particular matter and a financial holding, if we're going to use an exemption, the thing we have to figure out is the exemption appropriate for that holding? Is the exemption sufficiently broad or sufficiently targeted to cover that thing?
Yes, and then likewise, as we're gonna talk about, these various of the exemptions cover different types of actual government matters. So, you not only have to make sure that the financial holding is amenable to that exemption, but then you also have to make sure the exemption covers the type of matter that you're anticipating the employee would be working on that gives them the conflict of interest.
So these exemptions are limited both in the kinds of holdings that they cover as well as the kinds of particular matters that they're available for.
Right.
So we have to be careful on both sides of that equation when we're looking at these.
And typically what we're talking about when we say type of particular matter, we don't have to be all smoke and mirrors here. I mean, the type of particular matter, we're basically saying, is it a specific party matter or is it a matter of general applicability? For the most part, our exemptions are going to cover one or the other or both of those.
And those specific party matters, those are the matters where we have named parties. So things like contracts, grants, licensing, investigations are particular matters of general applicability. Are those broader matters that affect a discrete and identifiable class, like maybe a rulemaking or a policy or that kind of thing, sort of broader things where you don't have named parties.
Right.
I think something else about 2640 that I find helpful is a lot of these definitions are in the regulation.
Yes.
So rely heavily on the definitions. If you're not sure what something is, there's a good chance that it's described in some detail in the definition section.
Yeah, and when we get into the exercises, you're going to see precisely what we mean by that. And in order to determine whether some of these exemptions apply, you're going to have to use the definitions section. The next part of the analysis process is certain of the exemptions have dollar values that have to be met, de minimis thresholds. So it's a matter of discerning whether or not the person's holdings meet those thresholds. And then if there are any other aspects of the exemption, any other criteria, any other definitions that need to be met to make sure all the other elements of the exemption are met.
And I think, this is kind of a lengthy process. And I think it's lengthy because these exemptions are specific.
Yes.
They're not kind of rules of thumb or broad things that you can, sort of keep in mind. They're really specific. They have specific elements that have to be met before we can apply them.
Very good. And apply them we are going to do. So we're going to start with the mutual funds and unit investment trusts, sort of talking about that. And so we're going to immediately jump in by looking at our first exercise, because the best way to learn and to get familiar with these regulations is by actually applying them in context, applying them to a set of facts. So our first exercise is this. You have a CIO who's working on various contracts for IT hardware, software, and services. And they have the following portfolio. They have $200,000 in Wells Fargo Advantage Endeavor Select Fund. They have $12,000 in Vanguard Information Technology Index, and they have $65,000 in iShares US Industrials. So when we're using our process, the first thing we want to ask ourselves is, will the outcome of the matter affect the holding? In other words, do we think we even have a potential to await conflict of interest here? And I think, Patrick, when we look at this, when you see that we've got contracts for IT hardware, software, and services, we got a CIO.
Right.
So anything that's touching information technology is basically going to be something in their wheelhouse.
Okay.
Now we're looking at what appear to be pooled investment vehicles. Why should we be concerned about a pooled investment vehicle?
Because those pooled investment vehicles hold or contain companies. Specific holdings or specific financial things that could pose a potential for conflict of interest for us, possibly. So.
And I think that I would assume that since information technology is an area that is a goodly part of our economy, that the likelihood that many mutual funds would have at least one holding that was in some sort of IT related thing is probably pretty high. I
think so. I think, when we look at the financial press or even just the normal press, we see a lot of discussion about technology holdings, technology stocks, technology companies, those sort of all across our economy now.
Mm-hmm.
We see a lot of that. So, we might have some overlap here.
Right, exactly. So when we think about, okay, so we think there is a real likelihood for a potential for conflict of interest because the outcome of the matters that they would be working on, that the holdings that they have are likely to contain IT-related types of financial holdings. So when we look at which exemption might apply, we've sort of given it away because we've said we're going to start out by looking at the exemptions for mutual funds and unit investment trusts because those are pooled investment vehicles, right?
Right. And, I think it makes sense that we have an exemption here because, as we were just discussing, for someone like our CIO, the presence of technology stocks, they're going to be in virtually every possible pooled investment vehicle. You're not going to find many funds that don't touch technology in some way.
Right.
So we'd have a situation where to be a CIO in the government, you'd be very constrained in the kinds of things you could hold.
Right.
So I guess that's what we're going to be looking at here.
Yes, it's exactly what we're going to be looking at. But this is where, when we said you need to get familiar with the definitions, we mean it. You really need to get familiar with the definitions because the first thing we have to determine is whether or not any of the things that our person holds that we think are pooled investment vehicles are actually qualify as a mutual fund for purposes of the 2640 exemptions. And here, if we look at the definition, we've given you the definition on the screen here, but you should become familiar with where it's located in the 2640 regs, which is at 102K in the definition section. And the mutual fund for purposes of our regulations, for purposes of these exemptions, means an entity which is registered as a management company under the Investment Company Act of 1940. For purposes of this part, the term mutual fund includes open-end and closed-end mutual funds and registered money market funds.
So we're not just talking about any pooled investment fund.
Right.
It's got to be a mutual fund.
It has to be a mutual fund that is a mutual fund that is registered under the Investment Company Act of 1940. There are other investment company acts of differing years. Mm-hmm. The mutual fund definition we use means the entity has to be registered under the Investment Company Act of 1940. Okay. So why don't we take a look? I've just given you a screenshot here. Typically we would go out to the net and actually walk you through this, but just for the sake of time, because we've got a lot of material to cover, I just gave you a screenshot. This is the first of the pooled investments that we saw that our employee had, which is Wells Fargo Advantage Endeavor. And there are a couple of things I want to point out about this. One is that there is a ticker symbol for it, and it's STAEX. And we're going to see some similarities among ticker symbols among mutual funds. So that's just and we're going to talk about that in a second, but just kind of pay attention to that. But in addition to that, there's a description of the fund, and below that there is a PDF with the fund filings. What do we mean by fund filings? What does that mean, Patrick?
So these are the documents that the funds have to provide to the Securities and Exchange Commission, periodically reporting on earnings, registrations, name changes, things like that. Mm-hmm.
Now, it's in those fund filings where you're going to find whether or not this is registered under the Investment Company Act of 1940. So if you see something and you're not sure whether or not it is actually a mutual fund, you can go to the fund filings, you can pull up one of their filings, and if you do
Control F.
A Control F for...
I just put 1940.
And you can just put 1940 in there, and it should pull up for you whether or not this particular fund is part of the Investment Company Act of 1940.
In my experience, almost all of these filings are filed pursuant to the requirements of the Act. Mm-hmm. So in many, many cases, you do that Control F for 1940, and you say, the filing itself will say, pursuant to the requirements of the Investment Company Act of 1940, we're furnishing the following information. Mm-hmm. Or in a footnote somewhere, it will say, we are subject to the Act. It's usually pretty easy to discern whether or not they're covered by the Act, reading almost any of the filings.
Okay. So that's just a heads up of that's where you can get that information if you're saying, how the heck am I supposed to know if it's a part of the Investment Company Act of 1940? Well, you can find it. And as I said, again, there's a ticker symbol that we're going to pay attention to too. So if we look at the next one, this was Vanguard Information Technology Index, which is the other fund that this individual had. And if we look at the ticker there, it seems to indicate that it's calling itself a mutual fund.
Right.
And it has a ticker symbol, again, that's a 5-letter ticker symbol with the last letter being X. And why do I keep pointing that out, Patrick?
Because usually if you have a 5-letter symbol ending in X, you're talking about a mutual fund. The SEC isn't loosey-goosey with who can call themselves mutual funds. To call yourself a mutual fund, usually you have to be a mutual fund. To have a ticker symbol that looks like a mutual fund, usually you have to be a mutual fund. So this is a really good hint. If you can find the fund and you can find the ticker symbol and it looks like one of these, there's a very, very, very strong likelihood that the exemption is going to be available to you.
And so for these first two holdings that our person has, they are in fact mutual funds. They are both registered in the Investment Company Act of 1940. But this is a clue to, is it 100% foolproof? Maybe not, but it's a pretty strong indicator that you've got a mutual fund. But what about our other holding, which was the iShares US Industrials?
So that's not 5 letters.
That's not 5 letters. How many? That's only 3 letters. It's IYJ.
Yeah, and that looks like a stock ticker symbol actually. We have an indication of the market we're trading on. But iShares US Industrials, that's not sort of a company name that I'm familiar with. It sort of looks like a fund and kind of also looks like a stock. Right.
Well, the iShares is the biggest trader of
exchange traded funds
in the country, I think.
Yeah, maybe in the world, but they're exchange traded funds. So it has a ticker symbol that looks like things that trade on exchanges, and indeed they do trade on exchanges.
Okay. So the question then is, okay, so it's an exchange traded fund. It's got a ticker symbol that makes it look like it's a security, not a mutual fund. So what have we said about exchange traded funds? And this is effectively what we have said about exchange traded funds.
Basically, they're funds. We treat them like mutual funds. The only distinction between these and mutual funds is the way they trade. So they trade on intraday exchanges. They have minute-by-minute prices rather than trading only at the close of a session. Otherwise, they're just the same. So we extend the availability of the exemptions to them.
So we treat them as if they were mutual funds because they are registered under the same statutory authorities as traditional mutual funds. So we believe, yes, they do qualify for the exemptions in Part 2640 that as if as mutual funds or unit investment trusts. Okay. Now there are some ETFs that you have to be mindful of because not all ETFs are created equal. Okay. So many ETFs are going to be subject to the mutual fund exemptions because they are under the Investment Company Act, yes. But there are some, and the critical ones are ones that are either invested in commodities or commodities futures. If you see an exchange-traded fund that's invested in commodities or commodity futures, they do not meet the definition of mutual fund or unit investment trust. So they are not, the mutual fund exemptions are not available for these. Commodities are registered under the Securities Act of 1933, and commodities futures are under a different act altogether.
Right. And I think, people get worried about this. And the thing that I like to keep in mind is something you said at the very beginning of the presentation, which is that you have to have a possible 208 nexus in order to need an exemption.
Right.
And for the majority of at least our financial disclosure filers, commodities futures and commodities, maybe, if you work at the Department of Agriculture, you may have concerns. If you work at the Commodities Futures Trading Commission, you might have some concerns. But for your sort of general procurement official or investigator, moving a commodities index is not going to pose a conflict of interest for a whole lot of people. So if you see that people have, an employee has a commodities ETF, the first question to ask yourself, is that possibly a conflict?
Right.
And only when you answer that question in the affirmative do you need to panic about the registration of the fund.
Right. We always have to start with, do we have a conflict? And then we worry about whether or not we have an exemption as a remediating thing for the conflict.
Right. So simply because the exemption isn't available doesn't automatically mean commodities ETFs are bad.
Right.
Or something like that. It just means that if you have a potential conflict, this exemption is not available.
Exactly. Okay, so is it a mutual fund? The question is, I don't know why I'm missing it. Oh, there we go. All 3 of the things that our CIO holds qualify as mutual funds. So that's just the first check the box. Are they mutual funds? Yes. So could they ostensibly could those exemptions be available for these?
Right.
Yes. So now we have to ask ourselves, is it a diversified fund or a sector fund? And the reason we need to know that is because we have two separate exemptions for mutual funds. One for those that are considered to be diversified and one for those that are considered to be sector. And Patrick, what is the definition of diversified? Because we have a definition for that too.
Yeah, and I think, this is really important to remember because you can really get wound around the axle thinking about, percentages or numbers. What we do is we don't ask you to go look at all the holdings of a fund. There could be hundreds of companies. What we do ask you to do is go look at the stated investment policy. And if a fund has a stated policy of focusing in an industry, business, single country other than the US, or bonds of a single state within the United States, it's a sector mutual fund. If they don't have such a stated policy, it's diversified.
Yes. And do not trust language that you see, for example, on a web page that where, like when the first one that I showed you where it had a description of the fund on it. Sometimes you'll see things like this is a non-diversified fund or whatever, that they're using vocabulary that exists for other purposes. They're not using vocabulary that or definitions that meet our 2640 definitions. Right. So you need to look at the policy and see whether or not the stated policy is that of concentrating investments in an industry, a business, or a single country other than the United States or bonds of a single state. So let's take a look at one quick thing I want to talk about and sort of touch and go on this is before we get into looking at each of those discrete things our filer has, just a general statement about trying not to conflate the concept of diversified mutual fund with the concept of accepted investment fund, because they are two separate concepts. One is a conflict of interest concept that is attendant to the exemptions that we use for 18 U.S.C. Section 208. The other, accepted investment fund, is a financial disclosure concept only. It only reaches to whether or not the holdings of a fund are reportable on your public financial disclosure report.
Right. So this is another case where when we're in 2640, we're dealing with 18 U.S.C. Section 208. There is no other place where we find exemptions to 18 U.S.C. Section 208. When we're over in 2634, we're talking about what has to go on a financial disclosure report. Those are two separate matters that actually have very little to do with each other. So if you're trying to decide if an exemption applies, use the definitions in 2640.
Yes. So I really recommend to folks, print out this slide because it does give you a nice breakdown of the differentiation between the two concepts and sort of what you need to be focusing on. It's kind of a quick and dirty, handy dandy job aid. So I just recommend just print it out. And if you have any confusion about it, your desk officers can certainly help walk you through the distinction between the two concepts. So let's look at our Wells Fargo Advantage Endeavor Select Fund. That was the first fund we looked at. And we have a fund summary here. And then looking at the fund summary, Patrick, is there anything there that makes you feel like you can sort of get a sensibility about this fund?
Yeah, no, I think this is the best place to start when we're trying to determine if something is diversified. And I see words in here that make me feel pretty good, kind of warm and fuzzy that we're going to get to diversification. We seek long-term capital appreciation. That doesn't sound like we focus on computer hardware. Right. That sounds like our goals are to make money in a certain way. We invest our assets in equities, securities, and some foreign securities and ADRs. So we buy stocks. That's not a single industry within the economy. We're in multiple countries. So that seems diversified-ish. And it looks like it principally invests in the equity securities of approximately 30 to 40 companies that offer potential for capital growth. Capital growth, also not an industry. Right. So what we have here is a stated policy of reaching financial objectives. In a particular way. We're looking for capital growth. And usually when you see those things, capital growth, income, capital appreciation, those kinds of things, we're looking at diversified funds. Right.
So let's take a look at the next one, which is Vanguard Information Technology Index. And there are a few sort of pieces of information here that I think are sort of give us a different feel, I think.
Yeah, this is tricky. So here we have an area of the economy, at least, that we're focusing on, right? It says we're looking at an index. We're focused on stocks of large, medium-sized, and small U.S. companies. That's all fine. But then it says in the information technology sector. The word sector is even there. So it sort of raises some, is this maybe a sector fund? I don't know.
Well, I think if we look a little more closely at when it talks about the sector, it says it's made up of companies in 3 general areas: technology, software and services, information technology, consulting and services, data processing, and then it looks like it's
hardware and equipment.
Computer and hardware. I mean, in my opinion, that's all still all intimately related. I don't see those as being entirely different industries. I mean, that's, in my opinion, if you are a CIO, you're doing all that stuff. I mean, and affecting, that is the industry you're primarily going to have engagement with. Okay. As a helpful resource, just to kind of give you guys a sensibility about where, because Patrick had talked about some language that he thought was illustrative of, in the first example, of being something that's likely not a sector fund. We have a diagram, what we used to call diagrams, a legal advisory dating from 2000 that talks about diversified and sector mutual funds. And at the end of that advisory, we do include a list of sector fund examples. So we give some titles that we think could be an indication of a sector fund. We're not saying this is absolutely dispositive, but we're saying that these are likely to be sector funds. And we give a list of that, and then we also give a list of things that we think are more likely to be diversified.
Right. And I think, there's something important to remember here is that just because something has a focus doesn't necessarily mean that it is a sector mutual fund. So we really need to look and see, are we focusing just in one business sector, the bonds of one state, one country? Because it's possible to have, say, a focus in more than one country. So you might be familiar with the BRIC fund, the Brazil, Russia, India, China fund. That's a diversified fund. It's not invested in one company. Some of the healthcare funds, when you look at some of the healthcare funds, you see that they invest in hospitals, pharmaceuticals, insurance companies, consulting firms, all over the place, medical devices, and all of these are included. And each of those individually might be an industry, but in aggregate, it's more than one industry. So they actually might qualify as diversified. So just because something seems to have a focus in an area doesn't mean that area is necessarily one industry or one company or one country outside of the US. You have to look a little further. And this opinion lays that out really well.
So, and here's just another example from the talks about different diversified fund examples. So as you were talking about, like a small cap, mid cap, large cap, venture capital, generic science, technology, consumer product services, et cetera. And we're going to sort of see that, I think, here when we get into this iShares U.S. Industrial. So, I mean, I'm making the call that I think that other one was a sector fund. I think that the IT technology thing was a sector fund.
Because they seem to be focused on technology hardware.
Yes.
Right. They weren't kind of all over the place. It was sort of like...
It wasn't technology like technology across industries. It was information technology is what it was.
People who make computers.
Yes, exactly. But if we look at the iShares U.S. Industrials, this is one where what you were just talking about, Patrick, I think comes really into play. It's talking about the performance of the industrial sector of the U.S. equity market.
Right.
So that's construction and materials, aerospace and defense, general industrials, electronic and electrical equipment, industrial engineering, industrial transportation, and support services.
So this is all over the place.
It is all over the place.
So we're talking about industrial stuff.
Right.
But that could be in the mining area, in electronics, in industrial engineering, transportation. So we're talking about trucks and IT systems.
Right.
Right. So we're all over the place. So even though this excludes some parts of the economy, it's still probably diversified.
Yeah, because it's not on a single industry.
Right.
Okay. So from in terms of whether or not the fund is diversified for purposes of the diversified mutual fund exemption, we're calling it that Wells Fargo is diversified, so it would qualify for the diversified fund exemption, and the iShares U.S. Industrials, contrary to what it looks like on its face,
Right.
is also subject to the diversified mutual fund exemption. So we're left with Vanguard. The Vanguard Information Technology Index is not diversified. So then we have to look at, does the value of the interest meet the de minimis? So for the sector mutual funds, well, for the diversified mutual funds, there is no de minimis.
You can have as much as you want.
You could have millions of dollars worth of that.
Right. So then you
would
buy
be
your
fine.
Spider shares or your Vanguard Total Market Fund or whatever you have, as much as you like. It's diversified, so we don't have to worry about it.
But for our sector mutual funds, there is a de minimis threshold, and the de minimis threshold is $50,000 or less.
Okay.
Okay. So when we look at how much our employee has $12,000, and $12,000 is clearly well below the $50,000 threshold. So while they can't avail themselves of the diversified mutual fund exemption, they clearly can avail themselves of the sector fund exemption.
And on the last slide, I saw you had aggregate. So it means we got to add them up. So if we had a few of these technology funds or funds that might be affected by a matter, we take all those together. We have to do some math.
Yes,
okay,
exactly. He only has one, but if he had more than one, we would have to aggregate those.
Okay, great.
And also, if I think of spouse or minor child,
right,
we would also have to aggregate those. Okay. So for purposes of our first example, we basically said that's how you march through a mutual fund and unit investment trust exemption analysis, and we found that we had two that were diversified that were subject to that exemption, and we found that we had one which was a sector fund and was subject to that exemption. Now, just a really quick word, and I mean really quick word, there's another exemption for sector mutual funds that seems a little bit more opaque.
Yes.
And sometimes the best way to describe or to explain that particular exemption is through an example. So effectively what the other sector fund example is trying to get at is, let's say our CIO has a sector fund, and his conflicts are with the IT industry, right? So let's say that he has a sector fund that doesn't concentrate its investments in IT. It concentrates its investments in the financial services or in banking.
Okay, so he's got the investment company banking fund 2019 or whatever. So right.
So he's got this banking fund. It's a sector fund, so it doesn't qualify for the diversified mutual fund exemption, right? So, and some of the holdings in that, even though it's a banking sector mutual fund,
right,
some of the holdings are actually IT companies with which he would have a conflict.
So we might look at this this fund up, and it says we make sure that 85+% of our investments are held in the banking sector. We may temporarily hold equities in other kinds of companies.
Right.
And on this particular day, let's say they have some Amazon shares in the banking fund. They needed somewhere to put the money. They were out of banking stock ideas, and they said, let's dump some in Amazon for the day.
Yeah.
This says we don't have to go in there every day and say, do they hold Amazon?
This basically says that we don't care if the person has a sector fund that has conflicting holdings in it, provided that the sector in which it's invested isn't the conflict. So if they have a sector mutual fund that's in a sector that does not conflict with their duties, then we don't care if that sector fund actually holds potentially conflicting holdings, as long as they're not the emphasis. It's not the sector in which the fund invests.
And especially some of these funds that are more actively managed, those holdings could change daily or even hourly. So it would be administratively impossible to monitor this. So what this basically says is we don't have to monitor it.
Right.
We look at the sector that they say they're focused on. If that poses a conflict, we look to see if we can use the de minimis. We don't have to look through and say, oh, at the bottom of page 9 of the prospectus, it said for a minute last year they held some Microsoft stock, so therefore you violated 208. This exemption takes care of that problem.
Yeah, this exemption means you don't have to worry about this at all. So it's like helping you not to have to think about it really at all. So the only time you really have to be worried is if someone has a sector fund and it's in a sector where they actually have a potential for conflict.
Okay, great.
Okay, so that was our treatment of mutual funds and unit investment trust exemptions. So we're going to move on to publicly traded securities, and this is our second exercise. Our second exercise is we now have a different employee, and this employee is going to be working on a regulation. And this regulation sets standards to reduce harmful bacteria at facilities that manufacture frozen dinners. Okay. We all need that, right? Okay. So employee's spouse and their 12-year-old son inherited Conagra stock, $2,500 each. And the employee also has $12,000 worth of stock in Nestle. So going back to our analysis process, the first thing we have to say is, do we think we have a potential conflict of interest between the employee's duties and these particular interests that we've identified?
Yeah, I think so.
Okay.
It just seems to be standard setting for regulations of frozen food manufacturing could implicate the financial interests of Conagra or Nestle, because we know or could find out that they're involved in those areas.
Mm-hmm. But does the regulation the fact that it's a regulation, this isn't like we're going to contract with them or we're investigating them. So why do we care about a regulation?
Well, it seems that this regulation is focused on a particular kind of business.
Mm-hmm.
We're not talking about a change to corporate tax rates. We're talking about a regulation of companies that manufacture frozen food.
Mm-hmm.
And I think those companies probably are a discrete and identifiable class. So therefore, we might have a particular matter of general applicability here,
mm-hmm.
which is covered under Section 208.
Okay. So this is a particular matter that we're dealing with. Even though it's not a specific party matter, it still falls within that matter of general applicability definition that we have, also in the regulation. Okay. And if you do look up Conagra Foods, you'll see that they are manufacturers of Healthy Choice and Banquet frozen meals, just to give you a sensibility about why we care about Conagra. And then Nestle, of course, they do Stouffer's and Lean Cuisine and some other frozen foods. So,
okay, so we're clear that they're going to be regulated.
Yeah, for sure. Okay, so the potential for gain or loss of the employee is clear. They have these interests in these food companies.
They own these companies.
And that was exactly what I was going to get at, is how do we analyze stock holdings? Because a lot of folks would say, well, a regulation, it's probably going to, one way or the other, it's going to affect the bottom line of the company. But is it really going to be so much as to affect the way the stock price? And isn't the stock price really what we're worried about here, Patrick?
No.
No. What do you mean, no?
No, and I think this is an area, actually, I think it's a good idea to focus on this maybe a little bit in training, where you have people who might have financial conflicts. When you own shares in a company, you own shares in a company. You get the right to vote on company decisions. You literally own part of the company.
Mm-hmm.
So we treat the company's interests like the employee's interests. Mm-hmm. And we say if something affects the company and you're an owner of that company, then it affects you.
Mm-hmm.
So we don't have to ask if this regulation is going to move the share price of Nestle or Conagra.
Right.
We just have to know that they're going to have to expend money or do something differently to come into compliance with it. Their regulatory environment is going to change. It's going to affect them financially. So therefore, we have a nexus and a potential for gain or loss.
Okay, very good. So which exemption might apply? Well, again, we have exemptions in 202 for interests in securities. And so we need to figure out whether or not that exemption or that series of exemptions could apply to our holdings, our employees' holdings. So just as with mutual fund, again, get really cozy with the definition section, because you're going to need to know what a security is, okay? And what a publicly traded security is, because if we look at the definitions for the security exemptions in 202, the requirement is that it be a publicly traded security. So a security it could be a common stock, preferred stock, a corporate bond, municipal security, long-term federal government security, et cetera, et cetera. But the key here is that in order to use the securities exemptions, they have to be publicly traded securities, and we have a definition for that. So Patrick, what do we mean by that?
Two definitions for one sentence.
For one sentence, yes.
So publicly traded means that the security has to be a security first, is registered with the SEC, and listed on a national or regional exchange, or traded through the NASDAQ.
Okay.
So it's a two-parter.
Mm-hmm.
We have to be registered with the SEC under the Act of 1934, and we have to be listed on an exchange.
Yes. Okay. So we understand that's the definition of publicly traded security for purposes of the exemption. So what do you think these things have in common, Patrick?
This is a tough one.
Because they all look very familiar, don't they?
Yeah, these are companies that we're familiar with. You know,
Yeah.
these are places that we've probably shopped, have products in our homes made
These
by
are
some
not
of these,
small.
not small organizations.
Mhm.
But I suspect Dell sort of gave it away here,
Mhm.
is I don't think these are publicly traded securities.
And you would be absolutely right.
Yeah, I remember Dell used to be, and then they went
Mhm.
private again.
Okay, so what do we mean by that? What does that effectively mean when we say, oh, it's not publicly traded? What does that mean?
You can't go out to the New York Stock Exchange or any of the other exchanges and buy shares on the common market, right? Basically, these are private companies. There may be ways to have equity in them. They can issue shares as private companies, but they're not traded on an exchange. They're not. You can't go to the New York Stock Exchange, look up the ticker symbol, and buy a few shares. That's not how they're traded.
And how would you know that? I mean, like, how would people know that?
Yeah.
How do you find out?
The easiest way I've found is to try and do just that, to try and find these companies either in a financial research website or on a market and see if you can find a ticker symbol. Because if you go out and try and find Dell's ticker symbol right now, you're not going to be successful because they don't have one, because they're not registered with the SEC and they don't trade on an exchange.
One thing I also found really helpful, actually, when I was preparing to do this presentation was I actually went out and did a search for like a list of like the largest, privately held companies. And every year, and I don't mean, this is no endorsement here, but every year Forbes does a list, like a top 20 or whatever list. So, if you just want to kind of get yourself a little familiar with kind of the universe of like the biggest players, the ones you might most likely see if you're going to see these, you can always do that. Go out and take a look and see if you can find a resource that can give you a list, a current list of the largest privately held companies.
What's kind of nice about privately held companies is that they're hard to get equity in. So you're not likely to see these with most employees. So it's a thing to check on, but you'll find that because they aren't traded on exchange, they're difficult to buy shares of. They're difficult to get equity interests in. So they don't come up that often.
Right.
But it's important to know that that's a requirement.
Okay. So for our first listed security, we have Conagra Foods, and so we've sort of highlighted a few things here, Patrick. And what is the significance of the little stuff that we've circled?
So we have two nice things here. One, we have a ticker symbol. We have a three-letter ticker symbol, and it indicates that it's traded on the New York Stock Exchange. NYSE stands for New York Stock Exchange. So we understand here that this is probably going to be publicly traded. If you're traded on the New York Stock Exchange, you're almost assuredly going to meet the definition. Okay.
So we're going to go with that. We're going to
publicly
say
traded.
Conagra is a publicly traded thing. Okay, so now let's look at Nestle.
Oh no.
Oh no. Oh no, that didn't sound good, Patrick. What do we mean by oh no?
that's less good.
Okay, what are we looking at and why did you say oh no?
So we have some strange things happening here. And we have actually both indicators of some strange things here. One, we have a 5-letter ticker symbol that does not end in X. All right, it looks like the ticker symbol is NSRGY.
Okay.
And then we have a suffix that says .pk.
Yeah.
And I know that .pk stands for pink sheets.
Pink sheets.
And if you're not familiar with the pink sheets are sort of an anachronism now because nothing's traded literally over the counter. But these were literally traded on pink slips of paper, not on an exchange. And when we see here, we see the market indicated other OTC. OTC means over the counter. So that's not an exchange. That's a privately, or it's not traded on an exchange. So it's not going to meet the definition of publicly traded for our purposes.
Oh boy.
And I think the reason for that is Nestle's not an American company. So they've probably not gone to the trouble of registering with the SEC.
Right.
So they might be traded on a foreign exchange, and they almost assuredly are. But if an American investor wants to purchase Nestle, they have to do it through the pink sheets or over the counter.
Gotcha.
So we have a problem here because our definition of publicly traded says it has to be traded on a U.S. exchange.
Okay. Okay, so it looks like that if this is what they have are these regular shares, these Nestle regular shares, that looks like they're traded over the counter. They're not traded on an exchange, so these are not going to be eligible for the publicly traded securities exemption.
They are not.
Okay. Well, one thing I also found is that Nestle also has what are called ADRs. So you can buy Nestle, either Nestle stock, or you can buy a Nestle ADR. Do you want to give us a quick and dirty about what an ADR is?
Yeah. So Nestle, as a foreign company, would like to be able to raise money from American investors. So they could do that by trading their common shares over the counter or through the pink sheets. And there are a whole bunch of investors that won't be able to avail themselves of that. The trading fees might be a little higher. Certain times retirement accounts might not allow you to hold them. Your broker might not be able to get them for you. So Nestle says, we like being traded on the London Exchange or wherever they're traded. But we would also like to be able to raise capital from U.S. investors. So we're going to make a thing called an American Depository Receipt, which is kind of like a fake share. And these sometimes trade on exchanges, sometimes they don't. But they can set up an American Depository Receipt program where those receipts trade on exchange just like a stock. They're registered with the SEC just like a stock. They are securities. And basically it's a piece of paper that entitles the holder to all of the benefits that a shareholder would have without actually having the shares.
Gotcha.
So there's sort of an administrative workaround for wanting to raise capital on more than one exchange in more than one country. So they like to be, they prefer to be traded in their home country, but they'd also like to sell securities in the US. So they set up an American Depository Receipt program, and maybe they go and get it listed on New York Stock Exchange and it gets a ticker symbol, and then good to go. We can use our publicly traded situation or our exemption. Those ADRs also might trade over the counter. So we still have to look. It doesn't automatically mean we don't have a problem. It just provides the possibility that it's traded on exchange.
Yes, and so if you look at the next slide that we have, and we've given two different examples of ADRs. And the first ADR is the one that you referred to, Patrick, where it's actually traded on an American exchange. It's traded on the New York Stock Exchange. That ADR qualifies for the securities exemption because it's registered with the Securities and Exchange Commission. It has a ticker symbol, and it's traded on an American exchange.
So we have BTI that looks like a normal ticker symbol that would be traded on the New York Stock Exchange, and we have an indication that that's true.
But BTI is not what our person has.
It is
what
not.
Our person has is Nestle. And when I looked up the Nestle ADRs, this is what I got on the Nestle ADR. They're traded over the counter. They're not traded on an American exchange. So the Nestle ones would not be eligible for the securities. So this is where we stand with respect to this publicly traded securities exemptions in terms of whether or not they're even available. For Conagra, yes. For Nestle, whether they hold Nestle stock or a Nestle ADR, neither of those qualifies for the securities exemption. So the next thing we have to figure out is what is the kind of matter that the employee is going to work on. So for this one, for Conagra, we know that Conagra is eligible because it's a publicly traded security. So we need to know what type of particular matter the employee is going to work on, because we have several different securities exemptions that you can use, and it's all going to depend on what the nature of the matter is that the employee is working on. Now, we said at the beginning that the employee is working on what?
A rulemaking.
A rulemaking, a regulation, a standard setting regulation. So that would fall into the category of which?
Particular matters of general applicability.
Okay.
You don't generally have parties to a rulemaking, except in very rare instances. So it's not a particular matter involving specific parties. It's going to affect the discrete and identifiable class of frozen food manufacturers. So it's therefore a particular matter of general applicability.
Okay. So when we look at the exemptions, we realize this matters because the dollar value de minimis that they can hold and still be outside the restrictions of the conflict of interest statute are going to depend on the nature of the matter that they're working on. Our person's going to be working on a matter of general applicability. So the dollar values that they can hold in all affected entities under this matter, while they're participating in this matter of general applicability, are they can hold no more than $25,000 in any one. But if they have more than one and they have to aggregate, they can't have more than $50,000 in all affected entities. Okay. So in terms of the matter of general applicability exclusion for publicly traded securities, we know that Nestle stock doesn't qualify, so we can't even think about that one.
They failed the threshold question.
They failed the the definitional question.
Right.
The Conagra stock, we meet the de minimis threshold because we only have 5,000. That's the 2,500 from the spouse and the 2,500 from the minor child we've aggregated, and 5,000 in that stock is less than the 25 in a single affected entity. Okay. So that was our analysis for publicly traded securities. So Patrick, how do we handle stock options? Why are stock options different, and what are they eligible for our exemptions?
It's an excellent question. So stock options are a little bit tricky, and if you're not familiar with what an option does, it either creates the right to buy or sell shares at a particular price at a fixed date certain in the future, or creates the obligation to do the same. Right? So these are contracts between individuals that allow them to get the benefits of a magnified benefit, actually, of holding the equity share. And they represent very similar concerns to ownership of the actual company. Actually, in some ways, it's a magnified concern. So, if you have options on a particular company and that share price moves up and down, the value of your option changes based on the amount that the shares price changes is magnified. So in a sense, they magnify your interest in the value of the company. So they create all the same concerns that we have with stocks, right? The things that affect the companies are going to affect you. So for conflicts of interest purposes, we treat them the same. The problem we have here is that they aren't securities.
Right.
There's not an
you
exchange.
don't actually hold a security in the company.
Right. You don't have.
It's a promise or
it's a contract.
It gives you permission to at some future date.
Right. You have either a right or an obligation, and there's a counterparty to it. So there's not a ticker symbol for stock options. You can't go on the New York Stock Exchange and look up the option symbol and buy an option. You have to go through a brokerage house and write an option and find someone who will take the other side of it with you. So they're not publicly traded securities, but they give you an equity interest just like stock does. So we treat them the same for 208 generally, but then when we look to see if the de minimis exemption is available, we find that it isn't, because they are not publicly traded for our purposes.
So typically then what do we ask people to do if we know that they have an insuperable conflict with options? They're not going to have they're not going to have the de minimis exemption available to them.
Yeah, so we have to look for another remedy. So, in most cases, if it's possible to divest of the option that poses a potential conflict, that's the cleanest way to go. Otherwise, you'd have to look at recusal, or I think in maybe rare instances, maybe a waiver would be appropriate.
Can you just forfeit them?
Sometimes. Sometimes you can just say, it depends. Some sorts of incentive stock options that you might have from a previous employer that haven't vested could be forfeited. Options that you just bought on the market, it may be a little different.
So that was our treatment of stock options. Now, I know that when we looked at the definition of security included corporate, it said, preferred stock and common stock, and it also said, corporate bonds. And I don't know how often people run across corporate bonds as a publicly traded security. But what I did want to just spend just a minute here just to talk about why do we care about corporate bonds, and how is the 208 analysis for corporate bonds different from the analysis for stock holdings. And I think one of the critical differences is that, with stock holding, it's an ownership interest in the company, and clearly anything that affects the company affects you as an owner of the company. When you have a corporate bond, you don't own the company. You're helping to purchase its debt, correct?
Yeah, the company owes you money.
Right.
Right.
So we're focused. So once we're dealing with a debt obligation, it's like any other debt obligation where our primary concern is going to be anything that would so affect the company as to affect its ability to make good on its debt obligations.
Right. No, exactly. So, we're looking at whether or not you could affect the ability or willingness of the company to make good on that obligation. When you bought the bond, you bought a promise to be repaid with interest. And we want to make sure that you don't do anything to affect their ability to make good on that promise. Right.
I mean, the only other way that you could affect it is if somehow you could affect the bond rating. Like if you were engaged in some sort of matter that would actually affect the bond rating.
We could change the value of the bond, that way. So it's a lesser standard.
Okay.
Right.
So it's not as direct.
It's not as direct.
Your financial interest is not as direct.
Right.
Okay. Okay, so we're going to turn to our final exemption that we promised we would cover today, which is employee benefit plans. And OGE just very recently issued an advisory on employee benefit plans. That was, I think we issued that in 2015, I believe. I've got it here. Let me just pull it up quickly. Yeah, in May 5th of 2015. Where we explained a little bit further how to interpret the diversified pool investment fund exemption. And we're going to be looking at a couple of examples here to help sort of sort that out. But just to let everybody know, and I think we gave you a copy of this, we sent you a copy of this, which is LA 1506. So our first example for this is you have someone who's investigating discrimination complaints in HUD's Office of Fair Housing in the Philadelphia regional office. This person previously worked for the city of Philadelphia and has retained an interest in its 457 deferred compensation plan. One of the investments in the plan is the T. Rowe Price Real Estate Fund, and it invests 80% of its assets in the equity securities of real estate companies. So what are we concerned about here? What would we potentially be concerned about here, Patrick?
Well, we do investigations, it looks like. And as we know from the definitions, an investigation qualifies as a specific party matter. And specific party matters are particular matters for purposes of 208.
Right. So
we'd be concerned about a nexus between these discrimination investigations and maybe the holdings of the 457.
Yeah, and what does it look like? The one here. I mean, we focused just on the one here, the T. Rowe Price Real Estate.
Yeah.
Real estate fund.
Real estate fund.
I mean, HUD deals in real estate, obviously, and so if you're investigating real estate. So that's the cause for concern.
Right.
Why we would even look at this and wonder if we needed to avail ourselves of an exemption. So, because this is a holding inside of a pension plan, we want to look at the employee benefit plans exemption first, I think, because it is held within the confines of a plan. So what 201C12 says is you can participate in any matter where the disqualifying financial interest arises from the underlying holdings of a pension plan that's established by a state government or a subdivision of the state for state and local employees. So let's go back to our example and look at that. Okay, sure. So we're looking at you can participate in any matter. So you could participate if the exemption applies. That would include an investigation where the disqualifying financial interest is in one of the underlying holdings of a state pension plan that's sponsored by a state government for its employees.
So this is a city pension. Do we think a city is a political subdivision of a state? I guess
so.
It seems
so we're looking at a state government or a subdivision of the state.
Okay.
And I would say I think the city of Philadelphia is a subdivision of the state of Pennsylvania.
Great. So this seems easy.
Although Pennsylvania isn't a state, I don't think it's
a Commonwealth. We have a definition of state.
I'm not sure that we do.
Yeah.
So yes. So I think our employee benefit plan exemption would apply here because we don't have to. It's just simply the fact that it is a plan, and and the entire plan is what is being exempted here, right?
Right.
So we're saying that because the conflict arises because of one of the underlying holdings, but that underlying holding is contained within a plan that is sponsored by a state or local government, boom, that's the entire plan is
end of analysis.
End of analysis. Why do you think we take we've devised such what appears to be a broad exemption for state and local government?
I suspect because the provisions in the tax rules that establish the authorities for states to create these put some restrictions on the kinds of things that they can offer through them, and that we found that mostly these offerings are fairly innocuous from a conflicts of interest perspective.
Yeah, I think that the types of things that they can invest in state pension plans are probably fairly conservative. So.
Right. So.
Okay, so let's move on to our next exercise, which is we have an attorney at the Consumer Product Safety Commission.
Okay.
Prior to joining the Consumer Product Safety Commission, they were in-house counsel at Sharp Toys.
Great.
Yes. bag of glass, you know. Reminds me of the Saturday Night Live. Sharp Toys has a 401k that's administered by Integrity Inc. And through that 401k, your employee has selected some individual stock holdings. So this is a 401k where they actually just give you things other than mutual funds that you can invest in. So you're invested in 14,000 in XYZ Corporation, and now at CPSC, you've been asked to participate in litigation.
All right.
Against. So what's our concern here?
So we're involved in litigation against XYZ Corp.
Mm-hmm.
So that's going to be a specific party matter for us, I think.
Mm-hmm.
Through our 401k, our tax advantaged account established by Sharp Toys, we hold common shares of XYZ Corp.
Mm-hmm.
That seems like a problem.
We're back to our securities issue where you're still an owner of XYZ Corp. And I don't think under any wild imagination you could say it would be okay to be an attorney litigating a company of which you were an owner.
Right.
That's kind of in conflict of interest defined. Right there.
That seems like a pretty clear nexus.
Yes,
yeah.
I think so too. So if we look at the employee benefit plan exemption in 201(c)(1)(3)(i), here I'm actually quoting from the LA, the legal advisory that we've given you, because the legal advisory really is the thing you're going to have to look to help you understand the way 201(c)(1)(3) is worded, because the wording in 201(c)(1)(3)(i) is a little opaque. So I'm quoting from the legal advisory, and the legal advisory says where a particular pooled investment fund meets the definition of diversified in Part 2640, an employee may rely on the exemption as to that fund when the employee holds the fund through a qualifying employee benefit plan. So we got to start by making sure that the employee benefit plan qualifies, then it's sort of independently managed.
Right.
And once you've determined that, then the exemption is going to reach to the plan and any holdings in that plan that meet the diversified definition.
Right.
Where you can't avail yourself of this exemption to reach into an employee benefit plan to exempt certain holdings is if those holdings are non-diversified, either pooled investment funds or other individual assets like stocks or bonds or anything else like that.
So I think this makes sense. So, if you have a situation where you have the plan and it meets those independently managed criteria, but through that plan, you own common shares of a specific company. The fact that the plan meets the criteria doesn't really matter to us. What we're concerned with is that in this case, you own XYZ Corp. Right. Whether you own it in this account or that account or some other account over there, you own it.
Right.
So we treat it like you own it.
Yes. And you can't use this exemption.
You can't use this exemption to fix the problem.
Right.
However, if you have something in this plan that's diversified for purpose of our definition of diversification, sure, that's what we intended this for.
Right. And I think what I want to sort of clarify for folks is kind of like, I'm sure there's some people who are saying, well, why do we need this? If we have the diversified mutual fund exemption, then why do we need this employee benefit plan exemption? And I think what this is really trying to reach to is you have employers who create very niche sort of even diversified funds that are offered exclusively through their employee 401k,
right,
that you couldn't get publicly. They're not traded on any public exchange. They're
right.
They're crafted precisely for.
So they've not jumped through the SEC hoops
right.
for these pooled investments because they're only offering them to employees of the company.
Right.
But for our purposes, they look a lot like diversified funds.
Right.
So the fact that they're maybe not registered under the Act, or they don't have the proper ticker symbol, we say, well, if it's in the employee plan, it meets those criteria, the independently managed criteria, and it's diversified. That's kind of the same thing. So this exemption is meant to take care of that eventuality.
Right. So it's basically going to try to get at, anything that's in an employee, benefit sort of like plan that otherwise would appear to sort of like qualify for the diversified mutual fund exemption, except that it's not under the Investment Company Act of 1940.
Right.
So what we're trying to say is, since you can't use the diversified mutual fund exemption because they're not under the Investment Act of 1940,
you can use
the employee benefit plan exemption, provided that the plan itself qualifies by virtue under our definition. So it's really it's just a way to try to not wind up making disqualifying diversified types of funds that, but for the Securities Act registration, would not pose any more of a problem than if they were under the Securities Act.
Basically, we have a different threshold consideration here.
Right.
For the mutual funds, first they have to be mutual funds, and then if they're diversified, the exemption's available. Here they have to be held in a qualifying employee benefit plan, and then if they're diversified, the exemption's available.
Right. Okay. Exactly. But we did not want to create some sort of huge loophole to allow people to otherwise hold non-diversified or like direct investments type, like securities types of investments, and then just use the 401k as sort of the subterfuge for allowing them to otherwise hold,
Right, because all of the problems in here in that situation is due if you just hold it in a non-tax advantaged account. We're trying to be sensible here.
Right. And that's not to say that you couldn't still use the securities exemptions for those securities if they're publicly traded securities. You could still use those exemptions. It's just saying you can't avail yourself of this exemption to exempt things that let's say wouldn't qualify for the other
exactly
exemptions. Okay. So we don't think that the employee benefit plan exemption is going to apply to these individual stock holdings. It may cover other things in the 401k plan, but it is not going to cover these individual stock holdings in XYZ Corp. Okay. And that's the last of our examples. I've given you a very it's a short list. It may not be entirely comprehensive, but we think the most significant resources that you're going to need to deal with 2640 exemptions, obviously the regulation itself, the diagrams that we mentioned earlier in the broadcast, as well as one that deals specifically with particular matters involving specific parties, particular matters and matters, the employee benefit plan, LA, and then we have some guides that are on our website that we would encourage you to also look at, that also give you some information about the application of these exemptions.
I think in these cases, this stuff seems very complicated. And I think where you really have a potential conflict under Section 208, and you need to determine if an exemption applies, it is appropriate that you should be very careful in that analysis, right? You want to go through an elemental analysis to make sure that if you're going to use an exemption, that it's appropriate. You should rely on those definitions. But also, you needn't become overwhelmed, because you only need to do this where you have a real possibility of a 208 problem. So if you remember that, the complexity can be frustrating at times. But if you think about what we're doing, we're basically allowing people to participate in matters that would otherwise be criminal. It's appropriate that we're very careful and specific in our analysis.
Yeah, and keeping with that, I would just say get very friendly and familiar with Part 2640 in terms of the definitions, because the definitions absolutely matter. I mean, they absolutely matter. So we would just encourage you, as we did today, to make sure that you're always making reference to the definitions and assuring yourself that what you're looking at is actually what you think you're looking at. And you might have to do a little spelunking in Edgar or online and be looking at some fund prospectus or but you really do need to drill down and make sure that that what you're looking at is what you think you're looking at.
And these aren't all the exemptions. 2640
has
a number of other exemptions, and in the future broadcast maybe we'll revisit some of the less common, more common exemptions.
And we really have given you the 64,000 foot treatment of these exemptions, but we just wanted to, this was for people who don't have a lot of familiarity with the 2640 exemptions. It gives you a taste of the complexity without completely overwhelming you with a superabundance of detail.
And I just have sort of one administrative announcement for folks who may be 278 reviewers or folks who are looking to recruit new 278 reviewers for the annual filing cycle that begins in May. We will be holding some distance learning events to help people prepare for the 278 review cycle. So if you're interested in that, we do have a number of resources on the YouTube channel, which is youtube.com/OGE Institute, and we will be adding to that collection in the coming months.
Absolutely. So do we want to open up the phone lines for questions?
Sure.
Thank you. At this time, if you would like to ask a question, please press star then 1. You will be prompted to record your first and last name. To withdraw your request, press star 2. Once again, to ask a question, press star then 1 now.
While we're waiting for our question, I think just to sort of sum up, remembering the relationship of the regulation to the law is very, very helpful here. So, when you're looking at 2640, you can avoid all sorts of confusion by remembering that it implements 18 U.S.C. Section 208.
Yeah.
And that's pretty much all it does. If you can keep that straight, there's a good chance that you'll avoid frustration.
Absolutely.
And it doesn't look like we have any questions on the Hangout. Do we have any questions on the phone?
At this time, I'm showing no questions.
Okay, excellent. Well, we either did a very good job or we've confused people so much.
A while ago.
But yeah, we'd like to thank everyone for joining us, and we look forward to seeing you again for a future broadcast. And thanks for joining us, Cheryl.
Thanks very much.